So what we wanted to do was just, remember, we're speaking to retail financial advisor, and we thought we'd come here and talk to you about sort of the outlook for big securities firms' shares. So on Tuesday, you released an outlook for the second quarter and beyond, and you slashed the earnings outlook for a few of these companies.
Right. So sort of like, what else is new?
Yeah. I mean, I guess even ratchet them down. So what's going on? Why did you? What's the outlook for these big broker dealers?
Well, unfortunately, and I wish I could be more optimistic about this, but what we have is something we've never seen before, right? And it's been a credit-driven recession, right? I mean, historically, when we've had recessions, what you have is you have the Federal Reserve worried that the economy is doing too well, and they tighten up, and that causes the economy to go into a recession. Unfortunately, this time it's a credit market that's causing us to go into a recession. So we've got all these big brokerage firms, right? All of them with large positions that are risk assets, right? These are the CDOs and the mortgages or the leverage loans, frozen on their balance sheet, and going into what would be a fixed income cycle. Well, in a fixed income cycle, what you get is the Treasury pulling down the yield curve. So you make a lot of money by going long duration or steepening yield curve bets, right? And then the economy turns around and you get the credit markets rallying and you make a lot of money on corporate bonds. Well, this time, the problem that they face is a big chunk of their balance sheet is now all just filled up. They can't put this stuff on. They can't leverage it. And on top of that, now you have the Federal Reserve, who came in to save the industry after Bear, strongly encouraging these firms to deleverage, de-risk.
Right.
So what you're going to have is you're going to have a cyclical downturn. That's just what we're in, right? But you're not going to have the boom in fixed income like you had. Now, we're getting some improvement in fixed income, but you're certainly not getting these problem assets coming off the balance sheet. So So we've got those institutional businesses, high margin businesses are dead. Retail looks fine, right? So retail's holding up.
That's the thing. So everything else. You look at these earnings reports coming out of these big firms. The capital markets group stinks, whatever. Investment banking stinks. And then over there in the retail part of the thing looks great or look better.
Well, we have to remember a little bit about retail. There's actually, I know this sounds odd, but there actually is a way of forecasting retail, and it's actually related to unemployment. When unemployment rises, what happens is the retail investor begins to take money and put it under their bed. And so what you'll see is less money go to mutual funds, more money go to commercial banks, less money go into brokerage accounts. So right now you're seeing the beginning of that, not a flow away from the brokers. You're seeing it flowing into money market accounts and away from the equity accounts. Well, okay, at least it's still going into the brokerage firms. But as the unemployment wave comes through, and that's sort of a 2009 event, late 2008 event, that's when you start seeing retail slowing. The issue that we kind of have is that the decline in retail really shows up in 2009. Now, for the brokerage firms, when we start getting the economy coming back, it's the institutional businesses that come back first. So that's going to be M&A coming back and equity underwriting coming back. So the high yield market. When the high yield market opens up, suddenly all the financial sponsors come back. So that high margin business comes back. So that's good for Goldman. That's good for Lehman. That's good for Morgan Stanley. It's good for Merrill. But we ought to think of the mixes of the firms.
So is it true that Sallie Krawcheck saved your life?
Absolutely.
How did
Sallie,
you do that?
I was in the process of interviewing with Keith Bryant to be their CFO, and of course that would be natural, right? I'd been a CFO and I become the CFO there, and Sallie calls me up and says, "Come on over, let's talk about being an equity research analyst." Well, I knew nothing about the equity.
Because she was over here at Bernstein.
She was the head of research.
Head of research,
and Sallie's very good about wrapping people around her finger. And she convinces me. She says, "Look, if you're going to take a chance, this is the time to do it." I would have been on the 101st floor of World Trade had Sallie not hired me. So I owe an awful lot to Sallie Krawcheck.